The financial information provided in this content is for informational purposes only and not for the purpose of providing specific financial advice. Please contact a financial professional to obtain specific financial advice.
One of the most important investments a company makes, and often one of the most expensive as well, is its CEO's compensation package. It's also one of the riskiest investments a company makes. Consider the case of John Thain. He spent 25 years at Goldman Sachs, rising to the head of the company's mortgage securities department, and then becoming president of the Goldman Sachs Group, essentially one of two chief operating officers. In 2004, he was named the CEO of the New York Stock Exchange, which at the time was embroiled in scandal because of the lavish pay of its previous CEO, while simultaneously being threatened by the rise of electronic stock trading. As CEO, Thain pushed the exchange to move toward electronic trading as well, and orchestrated mergers with other trading systems and exchanges. This move seemed to rejuvenate the New York Stock Exchange and earn Thain the title of Mr. Fix-It. The $4 million a year that was reportedly paid to Thain seemed well worth it. Merrill Lynch then hired Thain as CEO at the end of 2007, based in large part on his track record at the New York Stock Exchange, or NYSE. But at Merrill, Thain seemed to make one mistake after another. It started with a refusal to acknowledge that Merrill Lynch's huge portfolio of mortgage-backed securities was in trouble, even after the company had to sell a big chunk of them at a 75% markdown in mid-2008. He was reluctant to discuss merging Merrill Lynch with another bank until he was essentially ordered by the Secretary of the Treasury, his old boss from Goldman Sachs, to do so. And things got even worse after Thain negotiated the sale of Merrill Lynch to Bank of America in late 2008. Thain reportedly requested a bonus of $40 million for arranging the sale, which was several times the bonus that the Bank of America CEO was expecting. He also arranged to have $3.6 billion of bonuses paid out to former Merrill employees in December of 2008, rather than waiting until January of the following year, the traditional time when bonuses were paid. When January 2009 did roll around, Merrill Lynch's fourth quarter numbers came in, reporting a $21 billion loss. That burned up about 40% of the amount that Bank of America paid for Merrill. It also caused the price of shares in the combined company to fall into the single-digit range, infuriating shareholders and Bank of America employees. To add insult to injury, word got out about the $1.2 million office renovation that Thain had Merrill Lynch pay for the previous year. That included a rug, just one rug, that reportedly cost $87,000. Bank of America showed John Thain the door at the end of January 2009. But in the short time he worked for Merrill Lynch, he earned over $83 million. Now, to be fair, Thain did go on to become the CEO of CIT, a medium-sized bank, and he helped this company turn its business around after a bankruptcy reorganization. He retired from that role in 2016, and the bank continued to be successful and was eventually bought by First Citizens Bank shares in 2022. While at CIT, Thain's compensation was reportedly in the neighborhood of $8 million a year. So Thain did really well as CEO of two companies, but was a disaster in another, and ironically, it was his worst performance that was by far the best compensated. But Thain's case is far from an outlier. In fact, this perverse outcome happens quite often. So how can the market for CEOs produce such variable outcomes even when we compare the same person's performance at different companies? And why does the market generate such large compensation packages, especially in light of the risk that the CEO won't actually be good for the company? Before we dive into answering these questions, let me back up and explain why I think understanding the market for CEOs is critical for us as investors. CEOs generally have inordinate power over the companies they lead. They not only choose the investments their companies make, but they also shape the culture within their companies, which in turn affects how effectively employees pursue the investment projects chosen by the CEO. Attracting and keeping a good CEO is arguably the most important investment that a company makes, because of their immense impact on value creation or destruction. When you and I invest in any security that a company issues, we're investing in the company's CEO as much as we are in the company's projects and assets. For example, if I want exposure to a big bank in my portfolio, I might buy JP Morgan Chase's shares because I think it's the best of the big banks. But along with making a bet on JP Morgan Chase's overall ability to create value, I'm also taking on exposure to its CEO, who was Jamie Dimon when I wrote this lecture. If I buy the company's stocks or bonds, I'm essentially buying into his plan to maintain the bank's growth and profitability, and hence to ensure that the stock price keeps rising and that the bank earns ample profits to cover its debts. I think keeping tabs on the CEO of a company I've invested in is just as important as reading the company's financial statements. American CEOs have particular influence over the companies they manage because of the way that corporate governance has evolved. When I say corporate governance, I mean the government of the company, literally who's in charge. We're all told that corporations work like representative democracies in which shareholders elect members of the boards of directors. The directors, in turn, hire and oversee the professional management team headed by the CEO, which runs the company day to day. But the reality of our current system stands the story on its head. That's because the CEO of a company is also a member of the board of directors. In fact, it's common in American corporations for the CEO to also serve as the chair of the board. This gives the CEO, in turn, a lot of input in the nomination of people to run for open seats on the board. And in most cases, the number of people running in board elections is exactly equal to the number of open seats. In other words, candidates generally run unopposed. So think about it for a second. If you were the CEO of a company and could exercise a good amount of control over the people who get elected to serve on the company's board, what would you do? Well, of course, you'd nominate people who are positively disposed toward you and your vision for the company, if not simply your friends. And these people, in turn, would owe you one, because you helped them get their board seats. By the way, board members earn tens, if not hundreds of thousands of dollars per year simply for showing up to a dozen meetings, if that many. Given this, should we be surprised that American CEOs operate without much fear of pushback from their boards? But even when they haven't necessarily handpicked their board, there are many other power imbalances between the board and the management team. Boards meet relatively infrequently, and directors often serve on multiple boards simultaneously, meaning that many simply don't have a good grasp of corporate operations. A 2013 survey of nearly 1,000 company directors found that only a third fully comprehended the strategies their companies were pursuing, and just 16% felt they had a strong understanding of the industry or product their company was involved in. Boards also have far less access to internal information than that of the executive team. The reports they read, the agenda they discuss, and who they hear from are all heavily shaped by the chief executives. And if the board lacks much depth in areas like risk assessment, auditing, or corporate accounting, their ability to independently assess their company's performance may be limited. Such power imbalances mean that even when boards are more independent, they can still be ineffective in their oversight roles. Germany has some of the most rigorous corporate governance laws in the world, with a mandatory two-tier governance structure and a supervisory board that must be completely independent of the management and include members with experience in areas like auditing. But massive corporate scandals at companies like Volkswagen, Deutsche Bank, and Siemens, which took place during record-high payouts to German CEOs, have led many experts to conclude the problems of corporate governance go deeper than just who picks the board. This is why I think that, no matter where you are, paying attention to a company's CEO is an essential part of investing. And while we're on the subject of corporate governance, let's look at the role it plays in CEO compensation. By now, we all know that CEO compensation is really high in American corporations. Let's look at a graph that shows us some specifics. This graph shows us the median compensation for CEOs of S&P 500 companies between 1995 and 2021. As expected, the graph shows a fairly steady rise in compensation, only interrupted by the periods associated with the bursting of the dot-com bubble, the global financial crisis, and the COVID-19 pandemic. As you look over these numbers, remember that these are medians, so that half the CEOs earn compensation below this amount during that year and half above it. In addition, the numbers report expected compensation, not actual compensation. Expected compensation includes the base salary, potential bonuses, the value of retirement contributions, and the current value of any stock options or actual shares in the company that the CEO could receive as part of their compensation. It's important to note that the base salary is only a small fraction of the CEO's expected compensation package on average, about 13% of overall compensation, according to the consulting firm Equilar. The vast majority of CEO compensation is performance-based, which includes bonuses and equity-based compensation such as stock options or shares of stock. The press often reports much higher CEO compensation numbers that include the value of stock options that CEOs exercised and shares that they sold. Since CEOs typically accumulate lots of stock options and shares over several years before they sell off these assets, their actual compensation in any given year could be huge. But keep in mind that when you hear about some amazingly high CEO payday in the tens of millions, this is generally the result of the CEO exercising stock options or selling shares received over several past years of compensation packages. I like the simpler numbers based on expected compensation, since they're more comparable across years. And as you can see, the amounts are still pretty big. And while the United States leads the world in CEO pay, similar trends have been observed across the OECD, with countries like Switzerland, the Netherlands, and the United Kingdom also seeing significant growth in CEO compensation. The high level of CEO pay is influenced by corporate governance. In fact, some financial economists have argued that the dominant role of the CEO, and especially their influence over selecting board members, is responsible for runaway growth in compensation. That makes for a good story, and I do agree that this plays a role. Friendly relations between the board members and the CEO probably mean that pay packages tend to err on the side of generosity. But it's also a good bit more complicated than that. For one thing, many, if not most corporations these days use compensation consultants to help them set the CEO's pay package. Boards want their CEO's compensation to be no lower than the average pay that other CEOs get. But of course, if everyone does that, we get what I call the Lake Wobegon effect on CEO pay. If you remember author Garrison Keillor and his radio show, A Prairie Home Companion, you may remember his stories about Lake Wobegon, his fictional hometown in Minnesota, where everyone's children are above average. Well, if every company wants to pay their CEO above the average, this is a recipe for rising compensation. I'm sure that CEOs pay attention to the pay that other CEOs earn and will feel insulted if their compensation doesn't measure up to that of their peers. In addition, one of the important goals that CEO compensation packages need to achieve is to motivate the CEO to keep working hard and innovating. So how do we motivate a CEO to work hard in the coming year when the company has just paid the person $10 million for last year's work? Well, you can either use a stick, which is the threat of firing the CEO if they turn in a mediocre or poor performance, or you can use a carrot, which would be an even larger and more attractive set of goodies they'll receive for performing well. Guess how easy boards find it is to use a stick to motivate CEOs? That's right, carrot it is. To keep CEOs motivated, many companies try to ratchet up each year's rewards for good performance. I could keep going on about why CEO pay is high, but hopefully you get the point that the reasons for this are complicated. And besides, the real question isn't how much a CEO earns, but whether they're worth the money. And again, the answer is complicated. For example, consider the story of John Mackey, the CEO of Whole Foods. He built a single health food store into a company with $6 billion in sales by the mid-2000s. That's a great story of a great performance. But in 2007, Mackey authored some emails and blog posts that put the value of this company at risk. At the time, Whole Foods was trying to acquire Wild Oats Marketplace, but the Federal Trade Commission was concerned that such a merger would be anti-competitive. And sure enough, it got a hold of an email that Mackey wrote to his board of directors in which he cited elimination of a rival and elimination of an acquisition opportunity for a conventional supermarket as two of his reasons for wanting to pursue the deal. And when the FTC sued to stop the deal, Mackey authored a 13,000-word blog attacking the commission, which among other things accused the FTC of being biased, adversarial, and arrogant. I'm not an antitrust expert, but I'm pretty sure that attacking the antitrust regulator in your blogs is not the best strategy for getting a merger approved. And it gets even better. The same year, it was discovered that Mackey had been posting predictions, under an assumed name about the performance of Whole Foods on an electronic bulletin board devoted to stock trading. He was mainly defending Whole Foods against other bloggers who were criticizing the company, but it put him on shaky ground with respect to SEC rules about corporate disclosures. And all that risk just to argue with a bunch of amateur investors. What this example shows is that CEOs are just like you and me in that their judgment can get clouded by emotions or other biases, and they can make some odd, if not downright bad decisions. And according to Hersh Shefrin, one of the leading experts on behavioral finance, being in the limelight all the time actually makes the situation worse. Shefrin calls this the visibility factor. The more publicly visible your actions and words are, the more this pressure amplifies your cognitive and emotional biases that get in the way of good decision-making. A CEO's emotional connection to the company they run, or as in the case of Mackey, they founded, can cause the CEO to take criticisms of their companies personally, and to go to absurd and possibly value-destroying lengths to defend the company and therefore themselves. Emotions and cognitive biases are just one of the things that make CEO performance highly variable. Another issue that I think is especially important to watch out for is what I call the one-trick pony. These are CEOs or other top executives who become successful in one company because they're able to make an important change or implement a winning strategy there. But this is the only thing they really know how to do, so when they move on to become CEO at the next company, they try the same thing. And chances are, it doesn't work so well there. A recent case in point was the experience of Mark Tritton, who became CEO of Bed Bath & Beyond in 2019. Bed Bath & Beyond had just experienced its first ever decline in sales, and a group of activist investors took control of the board of directors in an attempt to turn sales growth around. Tritton had made a name as the chief merchandiser at Target Corporation, one of America's leading discount retailers, by refreshing the company's stores, cutting back on coupon offers, and moving heavily into private label brands. When he moved to Bed Bath & Beyond to become CEO, Tritton tried the same strategy. But Bed Bath & Beyond's core customers liked being able to use the company's 20% off coupons to purchase national brand names at a good discount, and didn't seem to mind the supposed clutter of the stores. The new strategy quickly alienated the company's most loyal customers. To make matters worse, the shift to private label brands occurred during the global supply chain crisis, causing shortages, delays, and higher costs than had been anticipated. Sales continued to fall, and Tritton was fired in mid-2022. The company declared bankruptcy less than a year later. On a personal note, I'll have to confess to being one of those shoppers who liked the coupons and didn't think the stores were particularly cluttered. I actually liked the collections of crazy kitchen gadgets by the checkout lanes, and apparently many other customers did too. There's one other common type of CEO I also want to discuss, the empire builder. Empire builders are so convinced of their gifts that they want to turn their companies into monuments to themselves. They usually do this by embarking on signature projects or going on acquisition sprees. And they don't feel limited in their choice of targets. They frequently expand their empires into completely different lines of business and product. This can work for a while, but eventually runs into trouble for shareholders. The empire builders' projects don't necessarily create much value because they're not held to the same standards as normal corporate projects. And empire builders inevitably stretch themselves too thin, which makes it even less likely that their projects will succeed. On the other hand, empire builders also tend to be larger-than-life characters with lots of charisma, who often become celebrities in their own right. This helps explain why they not only get away with their empire building, but they're often encouraged to do it by shareholders. For example, I think that Elon Musk will go down as one of the great empire-building CEOs. Let's see, there's Tesla and SpaceX and The Boring Company for starters. And in 2022, Musk was forced to put his money where his mouth was and acquire the social media company Twitter. But his supporters, many of whom seem to be my students, keep cheering him on, confident that he can juggle all of these companies and turn each one into a world leader. And I have to admit, most empire builders do seem to have extra capacity and talent that many other garden-variety CEOs lack. For example, Richard Branson is another empire builder who had a great run and seemed able to start successful businesses in just about any industry. To some degree, that success can be propelled by the sheer value of the brand they've created. Branson's Virgin brand runs through all his ventures, each launched to great fanfare and often at least initial success. Empire builders may eventually pursue one conquest too many, though, and this ends badly for shareholders. Virgin Orbit is a good case in point. It went public in 2022, but declared bankruptcy in mid-2023 after a failed orbital satellite launch. There have been many less public Branson failures too, including Virgin Cola, Virgin Games, and the amusingly named Virgin Brides, all of which went bust. If there's a common factor underlying all my examples, it's a cognitive bias that behavioral economists call the overconfidence bias. CEOs tend to be confident people, and in fact, they tend to overestimate their abilities. Their overconfidence leads them to trust their own instincts and emotions too much, leading to episodes like John Mackey's behavior at Whole Foods. It also leads them to believe that they've found the one-size-fits-all solution to performance problems, as we saw with Mark Tritton. And they believe that their abilities entitled them to run huge, far-flung enterprises like Musk and Branson. But the fact is, the cognitive biases of investors like you and me have created a market for CEOs that selects for overconfidence. We want our leaders to be bigger than life, and we tend to follow people who appear confident in themselves. We confuse charisma for competence, substituting how much we like someone for an objective estimate of their actual abilities. We turn CEOs into celebrities, and we seem to be willing to pay them as if they were. Now, as my example suggests, the people who rise to become CEOs are generally very talented people, and they really do help companies create value. For many years, Sergio Marchionne, as CEO of the Italian automaker Fiat, was the highest-paid executive in Italy. Headlines there in 2016 decried the fact that he earned around 60,000 euros a day, more than most Italians earned in a year. Prior to Marchionne's takeover in 2004, though, Fiat had not been profitable for years and was feared to be on the brink of collapse. Within a couple of years, Marchionne had turned the company around, eventually merging with Chrysler to become one of the world's largest auto groups. While Marchionne's salary was high, Fiat's turnaround was worth more. With hundreds of thousands of employees, in 2016, experts estimated Fiat provided 136 billion euros to the Italian economy. That's nearly 400 million a day. And you do not need to look far for other stories of dramatic turnarounds, from Steve Jobs' return to Apple to Meg Whitman at eBay and Hewlett-Packard. CEOs clearly do matter, and to their boards, the millions they make in compensation probably don't seem large compared to the billions their companies stand to make. But the problem is, at the end of the day, CEOs are still people like the rest of us, who have bad days, blind spots, and biases. They can end up running companies that really aren't a good fit for their abilities. They can make bad decisions and then double down on them under pressure, rather than admitting they were wrong. So the question is, given that this is what the market for CEOs gives us, what should I do as an investor? As I mentioned at the beginning of this lecture, I think the best defense is to keep tabs on the CEOs of the companies I invest in, at least in the cases of significant investments that I make directly, like buying corporate bonds. If I'm invested in actively managed mutual funds, I have to trust that the fund managers are taking the CEOs and their behavior into account. If I invest into passive index funds, then I just have to hope that average CEO behavior is pretty good. And I honestly think it is. But if I'm investing in the securities of an individual company, then I need to follow the CEO's words and actions closely. Given the lessons of this lecture, what I'd really like to know is what the CEO is thinking. But the best I can do is to examine what they say and do, since that's the only evidence I have. I need to compare the CEO's actions and the statements they make to justify those actions with my understanding of the company's current situation. That's yet another reason to pay close attention to the company's financial statements and other performance measures. I especially need to look out for signs that the CEO is too emotionally invested in the company, too confident in their own version of events, or too convinced of the superiority of their own insights or their vision for the future of the company. And if the CEO is putting the plane into a nosedive, I need to be ready to bail out. And above all, I need to avoid my own tendency to be taken in by the CEO's confident attitude, winning smile, and best-selling book, ghostwritten, of course. It's hard to cut through the glamour of the modern celebrity CEO and make an objective judgment about their performance. But I have to remember, I'm the CEO of my portfolio, and I have to answer to the most important set of shareholders, my family.